There is a long-standing assumption in personal finance that real estate and stocks represent two competing paths to wealth, one grounded in physical ownership and the other in financial markets. But when you strip away narrative preference and look directly at the structure of returns over time, what emerges is not a debate of ideology, but a comparison of mathematical systems that behave very differently depending on scale, time horizon, and reinvestment behavior. At the core of both systems is compounding, but the way compounding expresses itself is not identical. In stocks, particularly through broad index investing, returns are primarily driven by price appreciation and reinvested dividends, which means growth is relatively frictionless once capital is deployed, and the system continues to operate without requiring active intervention. In real estate, compounding is layered through a combination of appreciation, rental income, leverage, and tax treatment, which creates a more complex but potentially more amplified structure of return when certain conditions align. The psychological distortion often begins with how these systems are experienced in practice rather than how they behave in theory. Stocks feel abstract, fluctuating daily in visible price movements that can trigger short-term emotional reactions, even though the underlying mechanics are relatively stable when viewed over long periods. Real estate feels tangible, anchored in physical space, which can create a perception of control and stability, even though its underlying financial structure is significantly more sensitive to local conditions, liquidity constraints, and financing environments. To understand the real comparison, it is necessary to separate perception from mechanism. Stocks generate returns through market-wide productivity and corporate earnings growth, distributed across thousands of companies, which means risk is diversified at the system level. Real estate generates returns through localized value extraction, where location, demand density, interest rates, and financing leverage determine the outcome, meaning risk is concentrated in fewer but larger variables. Mathematically, this creates two different compounding curves. Stocks tend to produce smoother exponential growth over long time horizons, where volatility exists but is absorbed by diversification and time. Real estate tends to produce stepwise growth, where value remains relatively flat for periods, then shifts significantly during cycles of expansion or credit availability. This difference in curve structure is often misunderstood as performance difference, when in reality it is a difference in timing distribution of returns. Another critical variable is leverage. Real estate typically allows for structural leverage through mortgages, which means a smaller amount of equity can control a larger asset base. This amplifies both gains and losses, and it introduces a sensitivity to interest rates that does not exist in unleveraged stock positions. Stocks can also be leveraged, but it is not inherent to the system in the same way, and therefore behaves more as an optional layer rather than a structural foundation. When leverage is introduced into any compounding system, the shape of the growth curve changes, not linearly, but exponentially in sensitivity to external conditions. This is why real estate can appear to outperform in certain environments, particularly during periods of declining interest rates and rising asset values, because leverage amplifies appreciation across a larger base of capital than was originally invested. However, this same mechanism also increases exposure during downturns, where asset values and financing conditions move in the opposite direction. Stocks, by contrast, adjust more continuously, because valuation is constantly repriced through liquid markets, which creates visible volatility but also faster absorption of macroeconomic information. There is also a less visible variable that affects both systems, which is capital efficiency. In stocks, capital remains highly liquid, meaning it can be reallocated without significant friction. In real estate, capital is relatively illiquid, meaning decisions are slower to reverse, and this introduces a time cost that is often not included in return calculations. That time cost affects opportunity cycles, because capital that is locked in one position cannot easily participate in others without restructuring. When comparing raw returns without accounting for liquidity, leverage, and reinvestment speed, the analysis becomes incomplete. Over long periods, historical data tends to show that diversified equity markets generate consistent real returns driven by productivity growth and reinvestment, while real estate returns are more regionally variable but can exceed averages in environments where leverage, tax efficiency, and supply constraints align. This is where the concept of hidden math becomes important. Neither system is universally superior because each system is sensitive to different variables. Stocks are primarily sensitive to global economic growth, corporate earnings, and market sentiment cycles. Real estate is primarily sensitive to interest rates, credit availability, population density shifts, and local economic conditions. When these variables align favorably, real estate can create accelerated wealth concentration due to leverage amplification. When they do not, the same structure can become capital-intensive with slower recovery periods. Stocks, meanwhile, tend to reflect global productivity in a more continuous way, which reduces dependency on localized conditions but also reduces the potential for structural leverage-based acceleration. From a behavioral perspective, investors often misinterpret these differences because they evaluate outcomes based on recent performance cycles rather than full-cycle completion. A real estate cycle that begins during low interest rates and rising demand can appear dominant for years, while a stock market experiencing volatility may appear inefficient, even though both are operating within expected mathematical bounds of their respective systems. Over longer horizons, the comparison becomes less about which asset wins and more about how each system interacts with time, liquidity, and reinvestment behavior. The real distinction is not performance in isolation, but how each system converts capital into future capital under different constraints. Stocks convert capital into growth through continuous market participation. Real estate converts capital into controlled leverage-based exposure to physical assets with embedded cash flow. One system is optimized for flexibility and compounding continuity. The other is optimized for structural leverage and localized amplification. Neither system eliminates risk. They simply distribute it differently across time and structure. When this is understood, the question shifts away from which one makes more money in absolute terms, and toward which system better fits the constraints of the person using it, including their time horizon, liquidity needs, tolerance for leverage, and ability to manage complexity. Because in financial systems like these, outcomes are not determined solely by returns. They are determined by how consistently the underlying structure can be maintained without disruption across time. And in that sense, the real math is not just about real estate versus stocks. It is about how different systems behave when capital is held inside them long enough for their structural properties to fully express themselves. Extending this comparison further requires looking at something that is often ignored in surface-level debates, which is how each system behaves during stress periods, because it is in periods of instability that the structural differences between real estate and stocks become mathematically visible rather than just theoretically described. In equity markets, stress tends to appear as rapid repricing. Valuations adjust quickly because liquidity allows for continuous exchange between buyers and sellers, which means price discovery happens in real time. This creates sharp drawdowns, but it also creates faster recovery dynamics, because assets are not trapped in illiquid positions and can be revalued immediately as expectations shift. In other words, the system absorbs shocks through price volatility rather than structural delay. Real estate behaves differently under the same conditions. Stress does not immediately translate into price adjustment at the same speed, because transactions are slower, financing conditions are more rigid, and sellers can choose to delay realization of losses. This creates the appearance of stability in the short term, but it often results in delayed correction, where adjustments are compressed into longer time windows. Mathematically, this means real estate tends to store stress, while stocks tend to release it continuously. Neither mechanism eliminates risk, but they distribute it differently across time. Another layer that becomes important in long-term comparisons is reinvestment velocity. In stock-based systems, dividends and capital gains can be reinvested almost immediately, which means capital can remain continuously engaged in the compounding process with minimal interruption. This creates what can be described as high-frequency compounding, where small incremental gains are continuously reintroduced into the system. In real estate, reinvestment is structurally slower. Even when rental income is generated, deploying that capital into new assets typically requires larger accumulation thresholds, financing arrangements, and transaction cycles. This creates a lower frequency but higher magnitude reinvestment pattern, where capital moves in larger but less frequent steps. Over time, these differences in velocity can produce similar theoretical returns, but very different experiential trajectories. One system feels continuous and fluid, while the other feels episodic and cyclical. There is also a deeper structural distinction in how each system handles scalability. Stock portfolios scale almost linearly with capital, meaning doubling capital generally doubles exposure and expected return characteristics, assuming similar allocation. Real estate does not scale linearly in the same way, because each additional unit introduces new layers of management, location-specific risk, financing constraints, and operational complexity. This means scalability in real estate is not purely mathematical, but partially operational, which introduces a form of friction that does not exist in purely financial instruments. As a result, real estate often reaches a point where returns become dependent not just on capital efficiency, but on system management efficiency. This is where the concept of cognitive load becomes relevant in financial systems. Stocks require relatively low ongoing decision density once allocation strategy is defined. Real estate requires continuous decision engagement, even in passive structures, because physical assets exist within environments that change independently of the investment itself. Maintenance cycles, tenant dynamics, regulatory changes, and local market shifts all contribute to ongoing system interaction. This does not make one system superior, but it does change the type of constraint being optimized. One system is primarily capital constrained, while the other is partially attention constrained. When comparing long-term outcomes, this distinction is often more important than raw return percentages. Because the limiting factor in wealth accumulation is not only capital growth, but the ability to sustain exposure to a system over time without structural breakdown in execution. Another subtle but important difference lies in how each system interacts with inflation. Both stocks and real estate are often described as inflation hedges, but they respond to inflation through different channels. Stocks tend to reflect inflation through corporate pricing power and earnings adjustments across sectors. Real estate tends to respond through replacement cost dynamics and rent adjustments, but these adjustments are often delayed and regionally uneven. This means neither system reacts instantly, but the transmission mechanisms differ in speed and consistency. Over long cycles, both systems tend to preserve purchasing power, but the path they take to do so is structurally different. Stocks adjust through distributed market repricing. Real estate adjusts through localized valuation shifts and income recalibration. When all of these layers are combined, volatility behavior, leverage structure, reinvestment velocity, scalability constraints, and inflation response, it becomes clear that the comparison between real estate and stocks is not a simple ranking of performance. It is a comparison of two different mathematical architectures of wealth formation. One architecture prioritizes liquidity, continuity, and systemic diversification. The other prioritizes leverage, tangibility, and localized amplification. And because these architectures respond differently to time, stress, and capital deployment, their outcomes cannot be universally compared without specifying the conditions under which the comparison is made. This is why the question, which makes more money, is incomplete on its own. The more precise question is under which conditions each system produces more efficient capital conversion relative to the constraints of the individual operating within it. Because in the end, financial systems do not operate in isolation from the person using them. They operate through them. And the efficiency of that interaction often determines more about long-term outcomes than the headline return of either.